Welcome to Investors Insights. Our topic today is charts don't lie. We're getting ready to pull back the curtain for you this morning and show you some data and insight that will have impact on your portfolio and your financial blueprint. And we think you will find it very beneficial. I'm also honored with those charts and that data that we'll be presenting today to have with me Bobby Norman, our Managing Director, Senior Vice President, Portfolio Strategies, Trey Booth, our Chief Investment Officer, Senior Vice President, Portfolio Strategies, and Ty Miller, Associate Vice President, Portfolio Strategies. We've just had a great conversation, and I'm looking forward to having this dialogue. With that also, several of you, I just want to say, as we continue the year, have asked about my book, Better, Richer, Fuller. If you want a copy of that, some of you requested, we will send that out to you directly. Some of you have asked to give it to family and friends, and it's a huge honor and compliment to me because the information in the book really complements some of the things that we talk about here on this vlog. With that said, Bobby, you showed some incredible charts this morning and data in regards to the S&P 500, in regards to inflation. So share that information with us.
Yeah, we want to give a quick update on where the market stands heading into a very important week of corporate earnings that Trey's going to talk about here in a second. But the S&P 500 has kicked off 2023 with a solid start, rising 4% before giving up some gains last week. So I want to show a few charts here that highlight the technical macro backdrop for the S&P 500, which should help the index finally break its downtrend in 2023. You can see in this top chart that going back to last January, the S&P 500's previous rally attempts failed to break through the 200-day moving average, which is that orange line seen in that chart. You can see the failed rally attempts and the red bubbles, and that's on that orange line there. That's the 200-day moving average, which today is at 39.71. So these failed rallies last year in March, April, July, and December were due to sharply rising interest rates and a big rally in the U.S. dollar. So the good news is these headwinds that we saw last year have largely subsided. As you can see in the second chart here, the 10-year Treasury yield has fallen to 3.5% and is in a pronounced downtrend. Also, you can see in the third chart for the U.S. dollar index, that's also in a pronounced downtrend. So the backdrop for inflation, which you can see here in this next chart, has also improved over the last year. The bottom panel shows and depicts that the recent peak in headline year-over-year inflation estimates for 2023 are coming down. So with yields, the U.S. dollar, and inflation all trending down, we're watching carefully to see if the market can finally break through and hold the very important 200-day moving average in what should be a less volatile year going forward.
And Bobby, that's great insight. And it also really complements the letter or email that we just sent out. I did my annual letter talking about what we experienced in 2022 and on into 2023. And your data, your charts confirm in regards to that letter. And I would say that to everybody here, please watch our vlogs. These charts, like Bobby just showed, they don't just appear magically. We subscribe to a lot of research here at Five Plan Partners in putting the pieces of the puzzle together as we navigate through the markets and tie that to your financial blueprint. So, Bobby, I thought you gave a great overview in looking in that. And like I said, if you haven't had a chance to read my email or the letter, please go back and take time and then listen again to what Bobby just shared. Trey, you tied in them because earnings move markets, move stocks. And so you did a fantastic job in relation to the information that Bobby provided talking about that. So can you elaborate on the sectors? And I think you've got another great chart to show us here.
Yeah, absolutely. Thanks, Greg. To support what Bobby was pointing out, we do seem to be having some technical strength here where we've created a bottoming process. Last year, it was all about inflation and the Fed's response to inflation and rising interest rates. And in this vacuum, since the last Fed meeting, the market seemed to be looking at earnings. And so something we felt was important to look at was where is our earnings season going and where does the market expect it to be? So this chart shows the change in earnings expectations to start the year off. Now only 10% of the S&P 500 earnings have reported. We're going to get a third of the S&P report this week. So it's going to be very market moving data. But you can see here, though, while the markets seem to be bottoming, earnings are coming out a little bit weaker than expected. Just since the beginning of this year, expectations have dropped by over 2% for negative earnings growth for the fourth quarter of negative 2.9%. That kind of conflicts with the revenue expectations of positive 4.1%. And what that is, that's inflation hitting company earnings and hitting the market directly. You have higher prices, you have more sales, but you also now are having higher costs. And so that's bringing your earnings down. If you strip it down in this chart and look at the specific sectors, you can see that the bulk of the earnings positivity is coming really from two sectors: energy, 61% earnings growth, and industrials, over 40% earnings growth. That's really pulling up the market, those two sectors. And that's where you saw a lot of the strength last year. So we're going to need to see a broadening out of that strength for this market to really find a sustainable bottom and to then move past this inflation and Fed-led market into an earnings-led market. Because at the end of the day, companies make money and they give that money to shareholders. That's what causes the price to go up sustainably. And so we're going to need to see those earnings improve. Going to get a lot of data out this week. Hopefully we're going to see some positivity, which can cause the market to rally like Bobby showed.
Yeah, and putting all that information together just gives us great insight on what we may be facing over the next few months and quarters. And so we're seeing a lot of positive trends there. And with that, Ty, you brought in a factor that we all need to stay focused on in regards to all this data, and that's dividends. Dividends play a key role in the markets. And talk about that in this past year and going into 2023.
As Trey just alluded to, companies giving back money to shareholders. Last year, 2022, we saw a record for dividends paid to shareholders, over $563 billion, which was a great sign because during COVID, a lot of companies had to cut dividends or pause them. Glad to see that we're back on track with rising dividends. And if I know it's only January, but we're on pace right now. If the dividend yield, stays the same, 2023 will be another record year, surpassing 2022. So that's a great sign. Historically, dividends have accounted for about 60% of the S&P total return, as you can see here in this chart. One factor there, though, is during the QE era, which was 2010 to about 2021, we saw only 26% of dividends only making up 26% of that S&P total return. So as we transition from QE to QT, it's going to be interesting to see if dividends start making up that more 60% range or getting closer, maybe finding a nice middle in between 26 and 60%. And then I guess my last data point would be companies are right now paying out 33.4% of their payouts, which is historically low. Typically, they pay out about 48%. So, I know last year was a record year, but it seems like 2023 is well on track to surpass that. And going forward, we should see dividends making up being more of a factor going forward.
No, you're absolutely right. And they play a key role in portfolio performance, as you said about the S&P 500, but as well as our clients' portfolios. And they also give us indications of industry sectors or how companies are passing on, their increase in revenues to their shareholders. A lot of factors go into that. So we talk about earnings, we talk about trends, we talk about interest rates and all these other things. But dividends are definitely a key marker that we need to keep an eye on. And I thought that was great insight on your part as well. So folks, we do these vlogs to be a benefit to you. We hope you've gotten a lot of information here this morning that helps you to be a little bit more optimistic about this year as we move forward. We also want to encourage you to continue watching these vlogs. Several of you are forwarding these to friends, family, and colleagues. We can't thank you enough for that. It's opened up doors for us, but also it sticks with our educational theme here at Five Plan Partners that we want to make a difference in people's lives and to educate them and to help contribute to their lives and hopefully for them to have better, richer, fuller lives. You can continue following us on our vlogs, but also our podcast, our social media, LinkedIn, Twitter, Facebook. We want to do everything we can to provide information to you. We thank you for watching today, and we look forward to our continued progress through this year as we educate, inform, and also have the opportunity to meet and talk with you. Thanks and have a great week.